When it comes to investing, there's one word everyone loves to talk about: risk. And we all agree it exists, kind of. We all get that if you want a return, you've got to take on some risk, but that's pretty much where the agreement shatters into a million pieces. Figuring out how to navigate all that disagreement is maybe one of the most important skills you can have as an investor. And this quote just hits the nail on the head, doesn't it? The only thing we can all nod along to is that if you put your money in stocks, you're taking on risk. That's it. That's the starting line. And from that one single starting point, it's a total free-for-all. Is risk something you should run away from or something you should embrace? Is it a danger or is it an opportunity? And how on earth do you even begin to measure it? So let's try to cut through some of that confusion. To get started, we've got to toss out the old broken compass. This common safe versus risky mindset, it's really holding us back. Before we can even think about measuring risk, we need a much better way to frame the whole idea. We're often taught to think in these really simple black and white terms. This stock is risky, this bond is safe. And yeah, it's a convenient way to organize the world. But the problem is, the real world just isn't that simple. The truth is, risk isn't an on-off switch. It's more like a volume dial. It's a continuum. Way over on one end, you've got investments where your return is basically guaranteed. And on the complete other end, you have things where you could literally lose everything. Every single investment you can imagine sits somewhere on that spectrum. Risk also comes from two different places. First, there's micro risk. That's stuff that's specific to just one company, like a new competitor pops up or the CEO makes a terrible decision. Then you've got macro risk. That's the big picture stuff that hits everybody, like when interest rates go up or the whole economy goes into a recession. Now, here's the crucial part. You can protect yourself from that micro risk, but you can't escape macro risk. Remember that because we're definitely coming back to it. Okay, so with this new framework in our heads, how do we actually go about measuring risk? Well, investors have basically come up with three main toolkits to try and put a number on this really abstract idea. So let's open them up and see what's inside. The first one, and by far the most common approach, is to just look at a stock's price history. The whole idea is pretty simple. If a stock's price is jumping all over the place, it's considered riskier than a stock that has a nice, stable price. The main tool for this is something called standard deviation. Now, it sounds a little technical, but all it really does is measure how much an investment's returns have bounced around their average. So, a high standard deviation means wild price swings, and therefore more perceived risk. A low one suggests a much smoother ride. So, what's the biggest advantage of this toolkit? The data is everywhere. Stock prices get updated every second, so calculating these measures is incredibly easy. But, and this is a big but, there's a catch. These measures can be biased by how much a stock gets traded, and they punish a stock for a huge price jump upwards just as much as for a huge drop downwards. Which, I don't know about you, but a big jump up doesn't feel very risky to me. So, for those investors who think the market is just too noisy and emotional, there's another toolkit. This one completely ignores the stock price and instead focuses on the performance of the actual business itself. Instead of looking at price volatility, this toolkit looks at earnings volatility. How consistent are the company's profits year after year? A company with stable, predictable earnings is seen as way less risky than one whose profits are all over the map. You'll find a lot of value investors are big fans of this method. But this toolkit has its own major drawback, and this quote from the source material just captures it perfectly. See, unlike stock prices, earnings only get reported 4 times a year, and while accountants sometimes have a way of smoothing things out, which can make a company's performance look a lot more stable than it really is. And that brings us to the third toolkit. This one is all about shortcuts. Instead of doing a bunch of complex calculations, these measures use simple company characteristics as a stand-in or a proxy for risk. I'm sure you've run into these before. For example, there's the assumption that smaller companies are just automatically riskier than huge, established ones, or that a stock with a really high price-to-earnings ratio is riskier than one with a low PE. Even the industry a company is in, like tech versus utilities, is used as a kind of shorthand for risk. They're quick rules of thumb, but they can be super misleading if you don't dig deeper. Okay, so we have these different toolkits, but the real magic, the big aha moment for so many investors, happens when we stop looking at stocks all by themselves and start looking at how they work together in a portfolio. This is one of the most fundamental questions in all of finance, Because what happens when you start combining investments, it isn't what you'd expect, but it is incredibly powerful. And this just illustrates the power of diversification perfectly. If you own just one stock, you're exposed to everything, the good, the bad, all of it. But as you add more stocks, those company-specific micro risks start to average each other out. A bad earnings report from one company gets offset by a great new product from another. By the time you own about 20 stocks, you've pretty much wiped out most of that diversifiable risk, and you're mainly just left with the macro risk that affects the whole market. So, we've broken down what risk is, how it's measured, and how it behaves in a portfolio. Now the final step is to bring it all together and figure out what it means for you. I love this piece of advice. The goal is not to avoid risk completely. The goal is to earn returns. Risk isn't the objective. It's the constraint you have to manage while you play the game. Your job is to decide what level of risk you can live with, and then go build the best portfolio you can within that constraint. You might decide that you think price-based measures are totally flawed, or that earnings-based ones are just too slow. And that's perfectly fine. You can throw out the specific models. But what you can't do is throw out the first principles, like the basic fact that some risk can be diversified away and some can't. That's the stuff you have to hold on to. So, which toolkit is the right one for you? Well, it really depends on your philosophy. If you think of yourself as an investor, someone who's buying a piece of a business for the long run, then focusing on the stability of that business's earnings makes a whole lot of sense. But if you're more of a trader, playing the short-term price moves, then those price-based measures are going to be your language. Ultimately, there is no single correct way to measure risk. It's all about finding a philosophy and a set of tools that align with your goals, your time frame, and just how you see the world. So the question isn't, what is risk? The real question is, what does risk mean to you, and how are you going to manage it?